Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi. Morning.
Hi, morning.
Hi, morning. Yesterday you missed the cascading sell-off. Yeah, where were you? This is your sign that you can't leave closing bell.
What did you guys do?
400-point fall in a span, 300-point fall in a span of 1 hour. Unbelievable. You know, the way the levels were just being taken off.
That's right. You know, people very, very nervous now, wondering which part of this correction are we in, start or the end? You know, the hope is that we're closer to the end. But I think when you're putting money, you'll have to think, if I'm putting money today for the next 5-7 years, which is the asset class I'm going to look at? And then I think you get your answer out there. That's personally what I'm doing.
Yeah, time horizons in that sense matter. Well, let's just take it from the top then, right? In terms of what you need to know as we begin this new session. So basically, US came back, right? US markets were shut on Monday, so they came back after this extended long weekend yesterday. And they were down 2% on the S&P. The Nasdaq was down about 2.5%. So in a way, I mean, the sell-off on Wall Street is a bit of a catch-up to the turmoil that we've seen, especially in European indices, etc. So that's the change. WIX, the CBOE WIX, the volatility index hit the highest since it's done so since November. Precious metals rallied, gold up 2.5%, silver prices up about 1%. And you also had 10-year bond yields in the US, which went up 7 basis points to 4.29%. So basically, I mean, you know, the long-term 200-day moving average, the 10-year bond yield is taken that out. Now, the story actually started yesterday during Asia with the Japanese bond market seeing an absolute bloodbath. So the very long end of the bond yield curve in Japan, that is the 30-year and the 40-year, yields on both those tenors jumped between 25 and 30 basis points. Actually, both went up over 25 basis points. The reason, of course, is the snap election, which has been called. And both the ruling, the government in place now and the opposition, both are promising fiscal expansion, tax cuts, without, of course, finding the money for it as of now. So, and that is the reason why the market actually got very, very jumpy. And, you know, for a market like Japan to move up, a rates market to give a 25 basis point move, it's absolutely unheard of. And we're at, 4% kind of levels now, especially if you look at the 30-year tenor. The Japanese finance ministry actually called for market calm and you know, the usual kind of stuff. This morning, the rates market is trading much better, but they're not retraced significantly or anything of that sort. So I think the story is this, and then it kind of showed up in U.S. Treasuries. So U.S. Treasuries sold off, as I just said, 7 basis points higher on the yields, and then it showed up in equities as well. So, but it began in right earnest with, of course, what happened in Asia. Now, this is largely a symbolic move. I'm just still with the bond market in the U.S. A Danish pension fund. It's not a very large pension fund. The way pension funds go, and that's the reason why I'm saying it's largely symbolic. And they openly came out and said that we're going to exit our U.S. Treasury positions by the end of the month. So there's this sell America, sell U.S. kind of trade. Some people have been talking about it. And I think this is, in a way, it kind of ties in with that. There was the other thing, right, which is the no Supreme Court ruling on Trump emergency tariffs once again. And by the way, now you don't have a date till the 20th of February. So 3 times now, no ruling. And by the way, some are of the belief that the longer the Supreme Court in the US takes to rule on this, the lower the chance that they are actually going to strike it down or partially strike some of these tariffs down. But anyway, we won't know at least until the 20th of February now. The big market-moving event, and it's not exactly, it's obviously not true that President Trump needs a stage to say what he wants to say and do what he wants to do. But nevertheless, he's essentially going to be standing up on that stage and the World Economic Forum in Davos and make a speech. It's our time, 6:30 in the evening. There's a Bloomberg story which says it's essentially going to be addressed at affordability and with an eye to midterms, lowering costs, etc. But will he talk about Greenland and some of the other hotspot issues? I think we'll need to see. And he could be he's always been market, not always, but he's been market moving in the past. His posts and tweets, etc., certainly have been. And I think in that sense, this is a risk to be watched out for. Now, just to come to our market, absolutely brutal sell-off. And by the way, it accelerated. Just look at yesterday's chart, right? Till 12 noon, nothing. And then 12 noon onwards, it just became like a one-way decline. 1,000 points in the sensex, 300-odd points in the nifty. Mid-cap and small-cap indices fell very sharply as well, between 1.5% and 2% each. The question is this: are we at the end of the fall? And there are those who believe that, yes, we are at the end of the fall. And think about it. The point is the Indian market has not done at least nothing. I mean, for the last year and a half now, whereas global markets have continued to rally hard. And we're in that same kind of phase, right? Too much supply from everyone. And there's only one buyer, which is the retail investor in India through SIPs and mutual fund investments. And everybody else has been the other side. As with the global markets having had very strong performance, as they start to see a bit of a wobble, we participate towards the fag end. That's the argument to say that, well, we're at the end of this fall, not at the beginning here in India at least. It's not as if the market sees a ripping rally higher, but maybe it's not the start of a fresh one. Let's hope that is the case. Unless, of course, I mean, the only reason I can see if we see a large fall from here is if global markets start to capitulate as well. And we've not had US markets, for example, fall 10% for a while. And they're sitting on very, very substantial gains. So that is still a debate that is to be had. The other thing, of course, is if this is a big global flight to safety, look at the dollar, right? The dollar index, etc. It's not rising. Usually money goes back home, and home is dollar, and the dollar isn't moving yet. So that gives some comfort, not too much, but I think it bears watching. Supports, I'll just leave you with levels. For the Nifty, 25,318 is basically just the swing low that we saw. The last big swing low we saw, it's close to where we are. And then it's the 200-day moving average, which is 25,114. For the Nifty Bank, we are still above the 20-day moving average, which is 59,587. And there's that big intermarket divergence as well, right? Financials looking much stronger relatively as compared to the Nifty, which of course has been hit by names like Reliance and others as well. So that's the picture. GIFT Nifty gives you a quick sense of where we are likely to start. It's about 10 points higher. Very, very undecided. F&O positioning, stats, how are we looking? Nigel has walked across to the wall. Nigel, over to you.
Well, as you said, Prashant, the reaction is what we're seeing in global equity markets. But the problem or the reason was the yields both in Japan as well as in the United States moving up. And that's what's caused global sentiment to get hit a little bit. Coming back to our markets, yesterday the FI sold closer on 3,000 crores. But the DI buying, well, that more than offset the FI selling. So the FI selling was not that much to see the kind of fall that we saw in yesterday's trading session. So part of the fall yesterday, if you just pull up a chart, will be attributed to the weekly expiry because we fell off the cliff, particularly in the last hour of trade. But the FI sell number is not that much. But you take a look at the small cap chart. Well, stocks saw big selling in the final hour of trade yesterday, and there were clear signs of capitulation that we saw. The hope is that, we're moving towards the end of this phase and not the start. Otherwise, this mid and the small caps could be in for a harder knock. Moving to the FIs on index futures, well, what did they do? They went ahead, they added close to around 8,500 short contracts. The short positioning is at around 91% odd. See, the FIs, they are piling on the shorts, and they're getting follow-through on the downside as well. So what the markets need is, the Nifty doesn't need to run away. It just needs to consolidate. They will not get follow-through on the downside, and then you're hoping for a bit of a bounce. In short, this market needs to stop falling. If that's the case, then it's giving you some kind of hope. Otherwise, the bears are getting follow-through on the short side. How's the positioning looking on index futures? Well, now you have the FI short positioning at around 2 lakh contracts. While the DIs, they are long at around 1.5 lakh contracts or thereabouts. Both these two at the highest that we have seen, extremes on both sides all the way since March 2025. The Nifty indicators are moving towards, the extremes. However, the structure is broken. And that's the problem for the Nifty. The PCR at around 0.7 odd. The Nifty RSI as well has slipped below that 30 odd mark, which sometimes suggests we're getting into that oversold territory at around 25 to around 30 or thereabouts. So both those two indicators are indicating we're towards the extreme. The problem is the structure. And because of that, the bounces that we see will actually get sold into. The options data comes up for you on the screen. You have the 25,300 call, well, fairly active in yesterday's trading session. Aggressive writing is what you're seeing. The premium coming down from more than 200 rupees to around 150 rupees. While you have the 25,000 put as well, that premium was holding at around the 70 rupees odd. So punching in that level, since there is some writing at around the 25,000 odd mark, you have the 200 DMA at around 25,100. That's the important mark. You don't want this mark to get broken decisively because now we're trading below the 20, the 50 DMA as well. So that's the important mark. Shouldn't get broken on the downside. Well, support comes in at around the 24,900 going by the options data. This band shouldn't get broken, otherwise in for a deeper gash. The Nifty Bank, as we said, well, that's been doing a relative outperformance. Yesterday it ended a little below the 20 DMA. This 59,000, 59,500 is important because the 50 and the 20 DMA come in that range. But otherwise, the recent low of around 58,500 shouldn't get broken. So you're hoping that you see a bit of a bounce, but I think first the market just needs to consolidate it, stop falling. That'll give bulls some kind of hope.
Got that. I think that is the big question, right? Are we towards the end of some sort of trend selling, or is this the start of a new downtrend, perhaps even in global markets? Are we going to see a bit of a reversal? James Knightley, Chief International Economist at ING, is now joining us on the show. James, thank you very much for joining in. If you look at just purely the market action, the price action yesterday on Wall Street, it appears to be, at least the consensus seems to be for now, that it's more episodic volatility driven by headlines rather than a prelude to a deeper crash. But the question is, because of Trump's policy uncertainty, are the fundamentals of the US economy in some way shifting? Can the fundamentals perhaps, result in a deeper correction that we will see in the stock markets in the US after a very long period of resilience?
Yeah, well, there's a lot going on right now. So we've got the geopolitical uncertainty tied to Greenland and Denmark and the threats against Europe. And of course, you've got then the overlay of the economic uncertainty relating to that with these threats of tariffs and the potential re-escalation of a global trade war story too. And then on top of that, as you rightly said earlier, throw in Japan as well. There's fiscal concerns in Japan with new elections set for Japan, with the prospects of a fiscal giveaway when debt to GDP is already well in excess of 200%, at a time when, of course, there's also this idea that Europe could weaponize its holdings of US assets as well. So there's a fiscal dynamic, there's an inflation dynamic tied to tariffs, and a portfolio dynamic as well, tied to this idea that Europe could weaponize its $10 trillion worth of assets it holds in the US market. So, as I say, there's a lot to go on. So we are going to be really closely watching Donald Trump's speech to see if he does try to de-escalate. Certainly his team have been, Scott Bessent and co have been trying to calm tensions a little bit. But of course, the president tends to be a little bit bombastic. So we'll just have to wait and see what he says.
Yeah, and James, it's not as if there's great popular support domestically in the US, right, for this Greenland plan. So it may actually eventually just lead to some kind of a compromise. I don't know. I mean, but do you think he may use the Davos platform to de-escalate? I mean, and kind of the question is, even if he kind of comes out and says, well, we're all friends and we're the same side and et cetera, it may calm nerves for a while, but has the damage been done in that sense?
Well, there is a sense that would be the end point. Donald Trump will push and push and push until he gets what he feels that he can get away with. But of course, this time around, Europe's already been through this once. They've already thought that they had a deal in place on tariffs, then that's been ripped up to some extent in their belief. Is Europe going to be as willing to take him at his word on this? So there is this concern that this, may get worse before it gets better in terms of, the mutual pain, because that's what it is likely to be. We are seeing these concerns in financial markets, both in the US and in Europe as well. But if you put barriers to trade up as well, if these tariffs do come through and Europe does reciprocate in early February, then again, that creates more economic uncertainty for US and European corporates. And we already know that the jobs market is cooling quite notably in the United States, and that could see the jobs market lose further momentum. So there are some real risks here for the US economy and for the European economy as well. And that does, of course, feed through into valuations in both equity markets, bond markets, and the dollar too.
All right, James, so you believe that Trump goes ahead with these tariffs on the European Union and he doesn't chicken out this time, right?
Well, I think, it's also down to what Europe does. I think Europe is likely to be much more robust in its response this time around. They thought they got a deal. That deal has been seemingly discarded. And we now have the Denmark and Greenland element to it as well. So I think there is going to be much more reluctance within European leaders to just try and just sign anything. I think there will be much more discussions about a broader agreement coming through. So that just means I would suggest that the risk is this takes longer to come to a resolution, and that leads to more market uncertainty for quite a long period of time, I think, unfortunately.
All right, and we're only a year into Trump's presidency. 3 to go, so that's a long time. James, what are you making of the spurt we're seeing in gold prices? Just looking at a trend overnight about the past bull cycles that we've seen in gold. And it's rallied big time in the past. But it had these periodic 5, 10, 15, 20% pullbacks as well. This time around, there's no sign of that whatsoever. It appears it's telling us a bigger message, with regard to the dollar, getting weaker. And also maybe that risky assets are in for a bit of a tougher ride. Your take?
Yeah, I think that's right. I think also, historically, we would typically expect treasuries to be a safe haven, treasury yields are rising, the dollar to be a safe haven, the dollar is actually selling off as well. So the pool of, so-called safe havens, as it were, seems to be shrinking. And gold is certainly there. Even crypto, Bitcoin has historically been used as been viewed as a potential safe haven, but that's still falling too. So, as I say, the pool of safe havens has shrunk significantly, and gold and silver are reaping the benefits of that. And until we get clarity on the economic and geopolitical environment, there seems to be little to prevent further gains right now.
Got that. Thanks very much, James, for joining us. It's a pleasure, and we'll hope to catch up once we have the speech from President Trump later today, and whether he uses that opportunity to de-escalate in that sense. Hopefully, he does. Well, more global voices essentially is what we want to get you. So this is, from Davos, Blackstone's chief, Stephen Schwarzman, spoke with my colleague Shireen Banan, the top sectors to watch in India in 2026 and more. Listen in.
We'll continue adding companies at an accelerated rate because we'll have the monies to do that. In real estate, there's always exciting things to do as data centers are developing. There have been a series of announcements, as you know, of what people hope to do. We're one of those hope-to-do people also. We've already been building some. Whenever you operate with a country that's on the right track, there are always new opportunities that you didn't see. We did something in the money management business there. That's done really well. Something in the housing business, that continues to do well. So, India has a very stable political structure now, and it's doing the right types of things. So we're finding an increasing number of things to do.
Okay, well, one of the top voices in the global world of finance. Let's take a quick look at what's coming up here in terms of interaction. So 8:35, Devin Choksi of Devin Choksi FinServ coming up to talk about markets and some specific stocks. 9 o'clock, Nuvama's Abneesh Roy to discuss the latest developments in restaurants brand Asia. It's a story which we broke here. We'll also talk about US health results. 9:20, Kodak's Pratik Gupta will be a market master of the day. 9:40, Management of Engineers India will join us to talk about the numbers. There is the quarter gone by. Macquarie Capital's Kunal Dhamesha will be chatting with us at 9:50, talk about the pharma sectors, QSQT expectations from the quarter. 10 o'clock, Sunil Singhania will be our big market voice, and he'll talk to us about where markets are headed from here. Towards the end of the program, Lata speaks with the former past secretary and CERC chairman PK Pujari and Nikhil Negani of Bernstein on how Indian power discoms have turned profitable as a whole for the first time.
Time to slip into a short break, but we'll get stock specific on the other side. We'll run you through our top 10 segment. For the time being, highlighting the stocks. Restaurant brands Asia, Persistent Systems, AU Small Finance Bank, Credit Access, Grameen, They'll be reacting to positive news flow, while United Spirits, SRF, Mastech, India Mart, Bazaar-style retail and Cupid will be reacting to negative news flow. Take that break, we get into further detail on all of these names.
Welcome back. Asian markets are firmly in the red as they begin Wednesday's trading session. Cuts of about 0.5% to 1% for the key indices. This is following the 2% rout that we had in Wall Street, where Wall Street suffered its worst single-day session decline since October of last year. There you have it. Taiwan down nearly 1%. The GIFT Nifty will also come up for you on your screen. But let's drill it down to stocks. Our entire research team is standing by with CNBC-TV18's list of top stocks for the day. But first up, let's congratulate Vivek, because the restaurants brand Asia story has played out. Take us through the details and what more has transpired in terms of the finer points.
Well, good morning. That's right. So in line with our news breaks, on November 24th of last year, as well as yesterday, what we've actually seen last evening is that Inspira Global, which is promoted by Ayush Agarwal, a part of the promoter group of Ajanta Pharma, is now going to go ahead and acquire a controlling stake in Restaurants Brand Asia. Remember, RBA operates the Burger King brand in India, and Inspira Global has QSR presence in India via the Chinese Wok as well as the Big Bowl brands. Now, what are the deal contours? First up, Inspira Global will infuse close to 1,500 crore rupees in Restaurant Brand Asia. 900 crore will be done via preferential allotment of equity shares and 600 crores through preferential allotment of warrants, both of which will be done at 70 rupees a share. The second step of this particular deal will be that they will be acquiring the entire 11.2% stake owned by the private equity Everstone Capital, and this will be done at a price of close to 460 crore. And lastly, given the change that there will be a change in the controlling stake, there was also an open offer that has been announced last evening. They will be looking to acquire an additional 26% stake in the company at 70 rupees a share. Now, MK Global has written on this particular deal. They say that the likely capital infusion goes ahead and significantly strengthens the balance sheet and should drive a re-rating. Remember, Burger King or RBA trades at a significant discount to its peers.
Okay, all right, Vivek, congratulations on that. The burgers are due. Thanks, Vivek, for that. Rima, but a couple of IT numbers came out. Persistent Systems, numbers look good.
Persistent numbers are fine. So the company has actually reported a strong quarter, a revenue growth of 4.1%, ahead of consensus expectations of 3.7%. The company's adjusted margins stand at 16.7%, again, higher than expectations of 15.5%. Reported margins and the bottom line has been hit on account of the wage bill, but adjusted margins are a beat compared to expectations. Now, what's interesting is the company says the reason for the improvement in margins is AI platform and tools-driven pricing model drove a 150 basis points increase in margins, but they went on to say that this will not be repeated in Q4 because any gains that they see will be reinvested back into the business. But AI platform and tools-driven pricing model driving a 150 basis points increase in the company's margins. They also went on to say that they're progressing on track to achieve their guidance of $2 billion of revenue by FY27 end and $5 billion by FY31. Numbers are fine, but the problem is in the case of Persistent is the high valuation. The stock trades at close to about 36, 38 times forward multiple, higher than most of the other peers.
Okay, all right. Thanks a lot for that, Rima. Hopping across to Mangalam, United Spirits. Mangalam, how are the numbers?
No cheers this time around for United Spirits. Why do I say that? Because one, volumes were below expectations. EBITDA was a miss largely because the company spent a little more on advertising, and revenue has been in line on higher realization. So if you look at the reported numbers, revenue is close to 3,700 crores this quarter. The street was working with a number of 3,650 crores, so largely in line. EBITDA 618 crores, the poll was 640 crores, so there's a miss. And that is a miss on the margins as well by about 70 basis points. And the net profit has come in at 529 crores versus a poll of 497 crores. Prestige and above, there the volumes have actually dipped by 2% as against expectations of 1 to 2% growth. And even the popular business volumes are down 9% versus expected 0 to 1% growth. The gross margins have improved and the realizations have improved as well. But the company spent 36% more on advertising and promotion this year as against last year. My sense is that because, the festive season shift was in this quarter, maybe they had to spend a little more. So ad spends as a percentage of sales at 14% versus 11%, seeing some red because of volume disappointment.
Got that. Thank you very much for that. Gaurav, it's over to you on AU Small Finance Bank and Credit Access Grameen. How are the numbers?
Well, as if you look at the numbers for AU Small Finance Bank, they were actually great. And the reason being that if you look at net interest income, that increased almost by 16% on a year-on-year basis. PPOP, which is pre-provisional operating profit, that remained flat because OPEX was high. But at the same time, if you look at profit number, that increased almost more than 20%. And the reason being that the credit cost was low. So let's first talk about what were the key positives for this quarter. First, if you look at net interest margins, they have expanded almost by 25 basis points on a sequential basis. Now, this jump is one of the highest that we have seen in third quarter for the bank so far. Apart from that, if you look at credit cost, now that has improved almost by 40 basis points from 1.2% to 0.78% for the quarter. And at the same time, let's also not forget that the overall 9-month FY26 credit cost stands at 1.1%. Now, what is positive again is that management reiterated their guidance that by in the end of FY26, the whole year credit cost is going to be 1%. So there is a further decline to credit cost is what they are suspecting. And at the same time, if you look at the other segments as well, MFI and credit card, both the segments, we are seeing some improvement in the asset quality. If you look at ROAs, now they stand at 1.6% and management also guides 1.8% ROAs in the coming year. So definitely good number here. When it comes to Credit Access Grameen, there also we saw improvement in numbers, and specifically these numbers when we are talking about is net interest margins and credit cost. Now net interest margins here expanded almost by 60 basis points to 13.9%, and at the same time credit cost that declined almost by 300 basis points on a sequential basis if you look at the annualized number. Now going ahead, they are also saying that the credit cost is likely to decline further, although in fourth quarter we may see the stable credit cost, and at the same time net interest margins will also have some room for growth. Remember the growth guidance for this quarter, the growth was just 8%, but they have maintained their guidance of 20% growth in loan book. So that is also something positive. So all in all, good numbers and at the same time positive commentary from the management. And on back of that, I believe if the market stays strong today, both the stocks can actually open in green.
All right. Thanks very much for that, Gaurav. Appreciate it. Well, SRF is the next one. Reported numbers. Sonal is here. Sonal.
The company reported numbers during closing bell yesterday and held a conference call later. The commentary did not put out a lot of positive comments as far as recovery is concerned. They spoke about persistent pricing pressure from Chinese competitors across some of the core product categories. However, they say that Chinese players will find it difficult to sustain at these levels, so they expect a reversal, but not very soon. As far as the agrochemicals segment is concerned, there was some positive commentary because they've started seeing some green shoots there, and they expect fourth quarter to be much stronger than the quarters before. But yes, there are tariffs uncertainty in the US markets which may continue to create short-term volatility in the fluorochemicals business. They say in the packaging films business they are seeing recovery both in BOPP and BOPET. However, they do say the business continues to be impacted by margin pressure in belting fabric, again because of Chinese imports and US tariffs, and management is cautiously optimistic on demand. So there's no commentary on further recovery that the management is expecting. Citi has a sell rating with a target price of 26.75. Morgan Stanley has an underweight rating. Even Jefferies has an underperform call with a target price of 26.40. So no commentary on recovery is something that the street might not like from the management today.
And Jefferies also points out, Sonal, that the stock outperformed the Nifty by 29% in 2025 on the back of the refrigerant gas strength. But today, as you pointed out, because of the conference calls, the company sounded a little downbeat about the recovery. The stock could be under pressure. A quick word on Mastech and India Mart. Now, India Mart's top line went up by 13.5%. Margins came in at 33.4%. And profits, though, went up by 56%. But the problem in India Mart has been the fact that their paying subscribers continue to deteriorate. And once again, in the current quarter, on a sequential basis, there is a drop in the paying subscribers. So that has been the problem for India Mart. Nomura has reduced call. They say there was an unexpected reduction in the paying subscribers. The company is experimenting with digital advertising, marketing, But because of this paying subscribers, they have a reduced call and they've lowered their PAT estimates by 2 to 4%. Jefferies, on the other hand, though, has upgraded IndiaMart to a hold. Not a buy, a hold, so maybe they see the risk-reward fairly favourable. Mastek, on the other hand, has reported a very weak top line. The company's revenues have declined by 5.5% on a quarter-on-quarter basis. There you have it, $102 million versus $108 million, so that is disappointing. Margin performance, though, has been very strong, 16.1%, and this is after accounting for the wage hike impact. So weak revenues, strong margins for Mastek.
Okay, all right. Thanks a lot for that, Rima. Well, hopping across to Mangla. Mangla, Nimesh had given us an insight that this was likely to take place. Bazaar-style retail, getting a big fund infusion coming in for Cupid. I'm sure you must be trying to figure out what kind of synergy benefits as well, but the street will not like it.
Well, it's very interesting because, 331 crore rupees coming in from Bazaar-style retail into Cupid. Preferential warrants convertible at around 328 rupees per share. Post-conversion, Cupid will hold about 11.3% stake in the company. Remember, Bazaar-style retail, the stock has in this market moved nearly 40% in the last 5 or 6 trading sessions, all the way up from 245, 247 rupees to about 331 rupees itself. And the conversion price is 328, 18 months from now. So maybe the street will see an adjustment for that, opening in the red for Bazaar-style retail. For Cupid, the interesting part is that, whether it gets the front that Bazaar-style retail has on the storefront, etc., to expand their sales in India or not. And from Cupid's standpoint, they get the leeway of 18 months as well. 331 crore, they pay about 75, 76 crores at the start for them to pay 18 months later. So it'll be very interesting to see where it goes. The street will find it unusual to start with, but synergies will be extremely crucial. Expecting some red on Bazaar-style retail, maybe a milder red or a slight green on Cupid as well, because the nature of the deal is very small as compared to their overall business.
Okay, well, Mangalam, thanks very much for that. Here's a quick recap of the top stocks that we're focusing on. So, Restaurant Brands Asia, Persistent Systems, AU Small Finance Bank, Credit Access Grameen, Cupid are some of the names on the green side, and with the negative news flow are United Spirits, SRF, Mastek, IndiaMart, and Bazaar-style retail. So we'll see how all of them open up. We'll take a quick break. We are back. We'll connect with Devin Choksi of DR Choksi Finserv with some fundamental conversation. Stay tuned. Coming up.
Welcome back. You're tuned in to Bazaar Morning Call. Well, let's get a couple of earnings then reactions on the show. We have J&K Bank. That's the first management on the show. The bank reported a strong set of numbers in the second quarter. The profit after tax, the deposits as well came in healthy. Although the NIMs saw a slight dip. We're now joined by Mr. Amitabh Chatterjee, the MD and CEO at J&K Bank. Well, we're going to be focusing on 3 focal points. Quarter 4 credit cost to be negative, the ROE expansion levers for FY27, and what's the possibility of the QIP in FY26? Well, Mr. Chatterjee, good morning. Welcome to the show. Let's start with the third point. Are you going ahead with the QIP? Do you think you should be doing it at this stage? And if you could tell us, why do you want to do it?
Very, very good morning, and thank you for having me here. You have a point there. The numbers are good, profit picking up and likely to pick up further in the coming years, coming quarters. So, yes, we have approval from our board. We are prepared for it, but maybe not this quarter, maybe next quarter or the quarter after that. But we are looking at our steady credit growth. And based on that, we will be taking a call as to when to go for the QIP. Otherwise, we are ready for it.
So QIP most likely in H1 of FY27, not in Q4 of FY26?
Yes.
Okay. The reason why we're persisting on asking this is because your valuations are less than, many of your peers. There is no immediate need for capital infusion. Your CRAR is about 15%. Your market price today is still lower than the QIP price of 2 years ago, which was about 107.6. So why push right now and dilute?
Very true, very true. You are right. And We will take a call based on going forward what we see. Since we have had a pretty good year this year, we had taken a call based on our numbers probably third quarter or fourth quarter of last year, where we felt that we needed. But now at the moment, since the bank has been doing so well, we will take a call maybe sometime later, H1 of next financial year.
Mr. Chatterjee, you mentioned that the Rural Infra Development Fund deposits will be maturing worth around 3,000 crores next year. And your PSL profile suggests no further need for fresh RIDF deposits. So over the course of the time, do you still think this QIP is required for the bank?
You have a point there. See, we were not in such a position earlier. We had introduced one product this year which gave us this position. If all the previous years we were required to invest in RIDF. So in spite of the RIDFs maturing, but we still had to invest more on that. So now we are in a position, as per the PSL positions now, we have become comfortable. So the decision to go for a QIP was based on the past history what we had. But since we have done so well during this year, we still hold on to the decision, but maybe we will take a call sometime later.
That's right. To be fair, you did take the board approval for QIP in November of last year. And as you say, things changed after that. What about loan growth? Very strong, 18%, but your guidance is only 12 to 15%. Why not up the guidance? And for FY27, how would loan growth look like?
In fact, if you remember in the last, last call itself, I had mentioned that the credit growth is likely to be 12 to 15%. The offtake was good and we had made certain changes in our processing. So the bank really did well in credit growth. And the best part is the combination of retail and corporate has been equal. And the contribution from both our home territory as well as the rest of India has also been equal. So since we could achieve what we strategized in the beginning of the year, so at the moment, I think I'll still say that the guidance for credit growth will be somewhere between 12 to 15%. Maybe there can be an upside. That also depends on how well we can improve our deposit position and CASA, of course.
With more questions, but we'll leave it there for now. It's a pleasure having you with us here bright and early this morning on CNBC-TV18, sir. Thank you. And good luck. That's J&K Bank with some perspective. We take a quick break here. We connect with Deven Choksi on the other side. Stay tuned. Welcome back. 15 minutes to go for the pre-open session. Hormuz is here with the big movers from yesterday. And, bulk of them on the downside, I imagine. Hormuz, so take it away.
Morning, Prashant. Yes, bulk of them on the downside indeed, and it was difficult to find stocks that were in the green in yesterday's session. But you start off with the index because that was the one that was in the spotlight all through the trading session. The top losers on the Nifty, Eternal being one of them reporting results today, Bajaj Finance being the other, Sun Pharma being the third one, all of them seeing trading volume significantly higher than their 20-day average. Eternal had over 8 crore shares that were traded, 3 crore shares was the 20-day average. Even Bajaj Finance had close to 1 crore shares being traded. Sun Pharma's volumes were 2.5 times its 20-day average as well. And you look at the delivery-based selling in all of these names. Eternal had selling worth close to 1,300 crores. Bajaj Finance over 500 crores. Sun Pharma almost 600 crore as well. So significant delivery-based selling in all of these names and on significant volumes as well. Now, the one name that stood out in yesterday's session was Jindal SAW, and it continues to extend its gains for the second session yesterday. It was up around 17-18% on Monday as well. Now, over the last two sessions, that the stock itself is up around 21% compared to the broader markets, which are down around 2.5-3% over the same period across Monday and Tuesday. And Even though there were shares worth almost 1,200 crores that were traded on Jindal SAW in yesterday's trading session, the delivery volumes were left a lot to desire because only 9.5% of those shares were marked for delivery. And lastly, Kaynes Technologies, it was the 5th straight day of losses for the stock. It's declined in 7 out of the last 8 sessions, but the declines have been on insignificant volumes. Now, the last 3 sessions, the volumes that you have had has been lower than the 20-day average on each of the last 3 sessions. Now, even in yesterday's trade, 12.5 lakh shares were traded. The 20-day average is 15.5 lakh shares. And even out of those 12.5 lakh shares, 2.5 lakh shares were marked for delivery. And that too is lower than the 20-day average delivery volume, which comes up to around 3 lakh shares. Now, the stock itself has had a not so promising start to the year, down around 14% in the month of January is Kaynes Tech.
All right, Hormuz, thank you very much for that. Appreciate it. Devin Choksi is with us with his views. Devin, I mean, there's got to be a bigger question about the market itself, right? Because if you're trying to do something against the broader trend of the market, then more often than not, you're sort of whipsawed, and that's true if you're in either sides in that sense. So, what's the bigger kind of trend here? And the question is this the market kind of finally capitulating, bottoming out? I'm talking about India. Or is this, are we just about starting to bleed? What's your sense?
Yeah, Prashant, good morning. I think the Indian markets included, we are basically victimized at this point of time due to the global actions. The currency dollar is basically, I think, coming under threat with most of the investors globally, including sovereign investors. And that's where probably I think they're trying to get rid of dollar assets. And that's where I think probably the collateral damage is getting extended to other asset classes, including emerging market equity. For force, I guess I think most of the global investors are selling out Indian equity largely to, I think, balance their portfolios in form of, I think, the dollar-related damage which is happening to their portfolios. And that's where probably I think technically the market is getting a little weaker compared to, I think, the fundamentals of the companies and the business. In fact, I think all of us squarely agree on one aspect. The business conditions in India probably has been, I think, extraordinarily robust at this point of time. Corporate earnings, I think, unquestionably, I think some of the best earnings that we are experiencing at this point of time. Unfortunately, I think due to this carnage which is happening in the dollar currency, and as a result of which, I think the collateral damage is extended to market like ours. You and me, I think, equally guessing on this subject as to till how long this will continue. We do not have the handle on it. But very unfortunate part is that I think we are still a victim of this situation. Our market should have possibly, I think, found out the way to not have this kind of, I think, situation. But unfortunately, I think that's not the case. I guess I think only patience is required at this point of time. Since the fundamentals remain absolutely strong and convincing, some patience is required at this point of time to hold on to your investments, good quality investments.
Well, that's right, Devin. I'm wondering, is it a valuation reset? Is it an earnings reset? Is it a sentiment reset? But patience will be the key. And, over the longer term, equities have shown that it's actually made you money if you get past these kind of turbulent times. You've got a few stocks, though, to talk about the event. So let's get straight to that. There are 2 large deals that we here at CNBC-TV18 were talking about. My colleague Vivek, he was on top of the Restaurant Brands Asia deal. And now we know the Ajanta Pharma promoter has gone ahead and, bought that stake from Everstone. What's the view? The burger market itself is very, very competitive. And in India, you always link a burger to McDonald's. So what kind of difference can they make? Any view on this deal? And then, if you have a view on the other one, which is the smaller one, the Style Bazaar as well as Cupid deal that was announced.
Good morning, Nigel. No, I don't think that I think immediately I have any view to offer on this subject, frankly. All said and done, I think any kind of acquisitions, I think, which are happening in this particular space is largely aimed at some amount of consolidations. I think that is what I would like to see. But how much it could possibly result into the impact into respective companies, maybe some more time required to analyze this aspect.
Okay, all right. So no big call on any of these stocks. It'll be interesting to see, how they react today, because Style Bazaar in particular is up, I think, 35-40% in a matter of a few days. Let's talk about some of the larger names, though, that came out with a set of numbers. Rima was telling us Persistent System. Those numbers at least look pretty okay. The growth was better than expected. We have seen that some of these stocks are not very, very cheap. But your view on persistent systems, or do you like something else from the tech pack?
So mid-tier IT companies are largely, I think, the victim of, I think, a higher amount of valuations. And that includes, I think, persistent as well in my viewpoint. I guess I think there is nothing wrong with the business. There is nothing wrong with the earnings, etc. And they're giving fairly good visibility for the future earning as well. Though I think you may not probably have to buy it because I think the valuations are remaining expensive. So it has been seen in case of L&T, Mindtree as well. I think there also we have seen the same situation. Mid-tier IT companies are actually, I think, getting corrected more on the valuations at this point of time. Maybe I think that process may continue for a longer period of time because we have seen a large part of the valuation building happening over the last 2-3 years, which is required to get corrected on time correction as well. So that's what I think we are likely to experience in many of these companies.
Okay, all right. Let's talk about a couple of other names. United Spirits, the stock has seen a correction from the top. All the alcohol companies actually have seen a bit of a derating. Post that sin tax that came in on ITC, or the duty hike that we saw, there's fears that something will be done even on the alcohol side of things. But I understand that's a state subject. It's not a center subject. Though the valuation derating is taking place. United Spirits came out with its set of numbers, and Mangalam told us not as good as what the street expected, or worse than what the street was working with. Your view on the stock, it's seen a good correction from the top, and there is that IPL deal as well that's in the works. So your take?
So I think when the valuations are high, I think the reasons are going to be many to correct these valuations. I think there can be any other reason I think that one can apply to it. However, I believe that I think when the companies are putting it at significantly higher valuations, there is little scope for making any kind of errors. And that's margin of error, as we call it, as I think is not available in most of the companies. So yes, I think today the investor is desperately wanting to recover the losses. As a result of it, even some of the holdings which have been held in the portfolios by investors, I think are now coming under pressure. We are seeing across, I think, many other companies, the portfolio offloading is taking place in some of the companies which were up till now, I think, very convincing investment opportunity for some. I guess I think only the time correction could possibly now solve the answer. Maybe the price correction will be simultaneous, but I think time correction would be painful, as I see it in some of these names.
Oh, yeah. I mean, Devin, I had a sort of slightly a strategy question, right, in your portfolio. And what happens is many times, people are they're watching. The market has been largely consolidating, right? The index, the Nifty, is still about 5% away from its highs, only 5%. But the damage, the median stock on the NSE 500 is down 25%. The median stock. It's not the average cut, but the median return now is minus 25. So, and then you get days like yesterday where there is much more significant damage. You kind of sort of lulled into thinking that, okay, it's a little bit of time correction and, let's ride it out, etc. Does it make sense to, and I've been saying this, and at least reflecting feedback from lots of institutional mutual fund managers, most have, over the last 1.5 months, actually I shouldn't say most, but many have gone into large caps. I mean, just to hide, right? And maybe Nigel mentioned ITC. That's a case in point. It's got a very strong dividend. So you, in a way, also get paid to wait. Names like REC and many others, right? So is that would you actively advocate something like that? So you go through your portfolio, what you have, I mean, and be more active about it at this point in time. What's your sense, Devin?
Yes, I think for some time, Prashant, I think we have been, on this subject. And we always say that I think the large cap companies, which are large in size, of course, I think with profits as well, I think those companies are finding favors in the portfolios of investors, including the mutual fund investors, largely because of the fact that I think the valuation comfort is far more higher compared to, I think, their peers in the mid cap and others, where I think the valuations have been actually, I think, factoring the growth which is not there. And as a result of which, I think those companies had to get corrected, which is now happening. The money is getting shifted out of some of the expensive mid-cap valuations company to the large cap companies, which are showing a reasonably good signs of, I think, growing at 15% plus rate of growth in their profit performance. And at the same time, I think they're available at compared to the mid caps and small caps particularly, I think they're available at a valuation which is far more inexpensive, as I would call it as. So, frankly, downside in the stock prices is less in some of the large cap. And you mentioned name of ITC. I think there are several other companies, including likes of Reliance, which has shown the character of, I think, showing 2 lakh crore of annualized EBITDA profit with this quarterly result. I would think that I think the money will smartly shift into some of the large cap companies. So the victims would be, I think, the expensive mid caps, I think, which are still putting at higher in premium valuations.
Okay. All right. Devin, well, we've got that. Thanks a lot for joining in and giving us all of those views. And Devin, we got a compliment coming in from one of our viewers. They're saying markets have done lots in the last few years, but Devin is looking absolutely the same. So kudos on that, Devin. That's a compliment that's come in on my personal message. Have a good day.
Thank you so much. Thank you.
Well, time to slip into a short break. Come back. We'll get the pre-open rates. We'll also connect with Nuvama's Abneesh Roy to discuss the latest developments in Restaurant Brands Asia, as well as United Spirits earnings. We'll also connect with our technical experts on the other side of the short break.
Welcome back. Over the last 15 days, the Nifty has lost in excess of 1,000 points, and in the process has also broken multiple support levels. Yesterday, we managed to hold on to that 25,200 mark, but precariously close to our 200-day moving average. The GIFT Nifty for now is implying maybe a flat with a positive bias to begin trade with. Best time to introduce our experts, technical experts Sudarshan Sakhani and Mitesh Thakkar on the show and get a sense of how we might open up for trade. Gentlemen, good morning. Thank you very much for joining in. Are we closer to this make or break level, 25,000, 25,100? What's the sense from here on? Mitesh, go first.
Yeah. So, good morning. I think the first level, and a very important level on the weekly chart was around 25,400. We closed below that, so this is not a weekly closing. So in that sense, there's still a few days left to figure it out. But if we don't start getting past 25,400, my sense is that there will be some kind of a negative breakdown on the medium-term charts. And then while the first minor support is around 25,000 itself, there's a good chance that 24,500 broadly could be tested, and then we'll look at a further level. So for the time being, 25,400 is the level which I'm watching for. The put call ratio in the short term is about 0.58 of 0.59. I think that's extremely oversold, so a pullback could happen. But as I said, the key on the upside is getting past 25,400 and capturing that level.
So till then, there is no trade, Mitesh, on the Nifty?
That's right. So till then, I would just wait it out and figure it out. We already have some put options on the Nifty, which are slightly longer dated options. So that is possible. But for the timing, I think, a fresh trade, I don't have a fresh trade right now. But in case you get closer to 25,400 on a pullback and there's lack of strength, then I think a fresh shorting trade will kind of emerge.
Gentlemen, morning, Sudarshan and Mitesh. Sudarshan, what about you? I mean, you've been, of course, asking to stay away, and staying away is what buyers are also doing at this point. What's the trade if there's one?
Yeah, good morning. See, the trade is to stay away. What happens is, Prashant, when we are sort of controlled by news, then levels are not important. There are no make or break levels because there is nothing to make or break. It is Mr. Trump who will decide it. And I'm just saying it in a lighter way. So news controls the market. When that is happening, we don't try to buy the dips. We don't try to do bottom fishing. We do nothing but step aside. At some point of time, this market will say, okay, I'm forgetting about the news. I'm not going down anymore. We'll have to wait for that event to happen. It's too early. So stay away from the Nifty completely.
Yeah, stay away from the Nifty completely. Sudarshan, just one more thing, right? This, look at the Nifty Bank Index, right? It's still above the 20-day, whereas the Nifty is kind of breaking all kinds of levels. So there's a bit of an intermarket divergence. How is that useful to keep that on one's radar at all as an indication of whether this rises, that falls more? What's your sense?
No, you're quite right. In fact, the Nifty is at the verge of breaking its 200-day moving average, while the bank is not. You're right. So what this tells us is that whenever the market begins to show a signs of a rally, it will first focus on the banks. Not today, but whenever that happens, the bank will be the first to run up.
Okay, got it. Sudarshan, what about individual ideas, trades, stocks?
Well, Hindustan Zinc is my only buy with a stop under 665. There are short ideas, but you have to short them on some small rallies. PI Industries is a short with a stop above 32.25. Tata Elxsi is a short with a stop above 5,500. And DMart is a short. I'm pretty downbeat on DMart with a stop above 37.30. But sell only on small rallies.
Sell only on small rallies. Got that. So Hindustan Zinc is the buy in that sense. Mitesh, what about you? What are your stock-specific ideas?
Yeah. So I have a mix of buys and sells today. I think, clearly there is a chance of a pullback, so some longs have been considered as well. I would, sorry, just a minute, yeah. I would go long on Dalmia Bharat Cement. That's one stock which did well even in a falling market yesterday. So keep a stop at about 21.64. Look for targets of 22.60 or thereabouts on the upside. And Angel One, the structure is very good. It's had 2 days of pullback. There's a good support at slightly lower level. There's a gap over there. So Angel One is a buy with a stop at 2584 for targets of around 26.70. And on the sell side is Eicher Motors. It's given some kind of a breakdown. So at a pullback close to about 7,200, which is about 0.3% higher than here. 7,200, 7,210, sell with a stop at about 70-80 and a target of around 70-50 can be looked at. And similarly, Ashok Leyland, it's broken that minor pivot of 184, 185. So on a pullback around, say, 182 half, sell with a stop at 185 half for a target of around 175, 176.
Got that. Mitesh and Sudarshan, thank you very much. We'll speak again, but that's the view, the broader setup, which is also important because it's not just about finding the right stock here and there. You've got to be with the broader trend as well, and that's essentially what we're trying to decipher at this point. Rupee, of course, is the other problem point, right? 91.08. Just think about it. For years we've been kind of used to a very, very reasonable range. Used to be 20-30 odd paisa kind of range, broad range I'm talking about, not about daily or weekly ranges. And the RBI was always there in that sense. To smoothen out the volatility, at least that was the experience of the last many years. Actually, it was quite incredible. It was such low volatility that people and it turned out to be a big boom time for those in the forex markets. I think starting 2020, 2021 onwards. But I think now, of course, that all that is kind of in the past. You've got all this stuff happening globally. You've got some local headwinds as well, which is, I guess, making a big difference at this point. So 91.15 or so. So it's another 0.25%, depreciation on the rupee, which means its dollar rupee is appreciating, which means the rupee is lower compared to it. So that is the rupee as well. For foreign investors, remember, the reason why this matters is, if you are able to take a call that the rupee is going to be significantly lower, say by the end of the year, you buy now at this rate, at this dollar rupee rate, and then the rupee falls more, when you're selling and taking the money out, to the extent that the rupee has fallen, it leaves you poorer as a foreign investor. So that is the other, that is the issue why it's kind of linked with equities as well. And the other, of course, point to note, it's all interlinked, is that FIIs themselves in equities have sold $3 billion this year, YTD, year to date. That's it, right? We are still in January. That is influencing, of course, what's happening. Not very much money coming in, dollars being taken out. And that, of course, is putting pressure on the dollar rupee rate. More demand for dollars, less demand for rupee. So it's like a cycle. It's like a vicious cycle in that sense, which one hopes is closer to some sort of a bottom rather than the beginning of another trend in that sense. Well, I think an acquisition is coming through. Satin Credit Care is they're up on your screen. They're buying Q Trino Labs. More later on this one. But the big deal yesterday, of course, is which we reported on, is basically confirmation of the CNBC-TV18 News break, is the fact that Restaurants Brand Asia, which is the operator for Burger King, has got a new owner. Is going to get a new owner. We'll have, and of course, there's also United Spirits numbers we want to talk about. Abneesh Roy is with us, Executive Director at Novama Institutional Equities. Abneesh, good to have you with us here. How would you read this, and what does it mean for Restaurant Brands Asia? Since it listed, it's never had an up year. I mean, I think the year it listed, it was up. Otherwise, I mean, for the last 4-5 years, it's been just one-way slide. Does it change the trajectory for investors? What would you make of it?
Sure. Good morning and thanks. I'll first take United Spirits and then I'll highlight on the RBA. On the United Spirits, we continue to have a stance more towards staples rather than sin sector. So we have seen in cigarette and liquor the same issue that both central and state governments are going for very high taxation. So United Spirits stock, we expect some more near-term softness, some more near-term correction because Maharashtra has seen a double-digit decline and that has led to overall EBITDA and volumes being soft. It's still a decent performance ex of Maharashtra and Andhra is also coming to the base. So this quarter, if you see what has happened, Maharashtra will again remain an issue for at least 2 more quarters. And UK FTA is also delayed because it needs the UK Parliament approval. So long-term story remains good. IPL value unlock is also something which can happen. But near term, I think United Spirits stock, even in Q4, will see weak number because of Maharashtra. So we continue to prefer Nestle, Marico, Britannia, etc. From a valuation perspective, HUL, Colgate looking good. Coming to RBA, definitely 3 things. It removes the overhang on promoter sale because the entire promoter that P stake sale now that overhang goes away. Fund infusion of 1,500 crore is a positive. Plus, if you see Ajanta Pharma, the promoter group, it's not Ajanta Pharma, the company, the promoters do have presence in that space. So there'll be synergy benefit because they do have Chinese Vogue, Big Bowl, etc. and the Momo company. So there'll be some synergy benefit from supply side and overall understanding. But definitely the 2 structural issues, which I think you also highlighted that stock hasn't done that well. Those I think continues to remain, right? The margin profile is suboptimal. The positioning is again something because the promoters were not that very much involved in the fundamental side because that stake sale was there. I think now that concern will get addressed, that what is the positioning of Burger King, because clearly McDonald's is there and there are so many other options for consumer. So I will say it's a positive development, but next 1 year we'll see on the transition with the new promoter how that happens. The management churn, what happens. In the entire QSR space, we continue to prefer Jubilant Foods, but I think there is a challenge overall. In the broader retail space, we like Titan and QSR will be underweight on the broader perspective.
Yeah, that stock is down 50% in the last 5 years. It was at 120 and now down to 65. So a lot depends on the strategy now of the new management and how they plan to use that fund infusion of 1,500 crore to expand operation. What are your estimates of growth for restaurants brand Asia vis-a-vis peers in the QSR space, and how are the valuations?
I think valuation is clearly quite favorable because the stock hasn't done well. If you see in terms of EV to sales, because that I think is a key metric, it's almost 1.5 times kind of multiple EV to sales. Yeah, margin profile and overall profitability has been disappointing because clearly overall positioning strategy wasn't challenge. So I would say that yes, in the near term, some relief rally can come, but long-term structural issue of margin and positioning, I think that continues to be a monitorable. So we would prefer Jubilant Foods. Yes, near term, I think the Q3 will see the GST 2.0 that benefit come into place and festival benefit. But in that space, I think Jubilant Foods is the best run company currently. But Burger King and RBA will be more of how the new promoters are able to have the synergy benefit and the positioning and margin challenge which continues to remain.
Yeah, no, absolutely. So in this space, right? I mean, it's generally a space, the QSR space, which is done very, very poorly across the board. If you look at price performances, anything you'd like to bet on, Abneesh, within the QSR space right now?
Yes, as I said, in the broader retail space, Titan is something which I think looks much more better. In the QSR space, yes, Jubilant Foods is growing faster than most other players. But again, there also, if you see broader challenges, there of too much of competition, right? Now with RBA also seeing fund infusion of 1,500 crores, they will again become aggressive both on discounting and store expansion. So net in QSR space, the competition and the e-commerce, quick commerce kind of a overall space that is providing more options to the consumer. So as of now, yes, Jubilant Foods is the best place, but we'll prefer Titan in the broader retail space.
What's in this Cupid Bazaar style retail deal, Abneesh?
No, we don't cover that company, so we'll not be able to comment.
Is ITC a good buy at current levels?
Currently, yes, valuation comfort is high, and next 2-3 months, you will see the price hikes come in 2-3 tranches. The dividend yield is 5%. FMCG is seeing good recovery post the GST cuts, even in paper, the Birla paper business, etc. But issue is currently investors will not see a big trigger in terms of volumes, right? There is a volume decline which is going to happen, and it could be in the range of 5% plus volume decline for the cigarette industry because of such high taxation. So it's more of a valuation 1 to 2 years call you'll have to take. Can there be some bounce back? Yes, that is possible given the sharp correction. But there is the BAT stake sale. We'll continue to monitor the overall FI selling. So we'll continue to prefer growth stocks currently. So Nestle, Britannia, Tata Consumer, Marico are looking better. And even in the staples other space like HUL and Colgate, we will see recovery in terms of business in Q4 because of the GST transition not being there. ITC more of a 1 to 2 year call someone will have to take.
Abneesh, we leave the conversation here for now. Thank you very much for joining in. 9-10 calls coming in now from our technical expert, Sudarshan.
DMart, consider going short in DMart with a stop above 37.30.
Mitesh?
Yeah, I'll go with the sell on iShare and would look at targets of around 70.50.
2 sell calls then at 9-10. Let's go across now to Sudarshan for the brokerage call of the morning.
Morgan Stanley has come out with a note on BHEL. It maintains the overweight call and increases target price to 304 rupees per share. It says a company should seize 70% market share in the power segment and expects execution to improve and legacy contracts to be completed in the few quarters. And industry segment could see traction over transportation, transmission and the defense. Credit Access Grameen has seen 2 upgrades. CLSA has upgraded the stock to buy and target is 1450 per share. It says non-MFI mix could be higher than 15% FY26 and details of redesigned business model and strategy in the next quarter that it's expecting. Second, HSBC has upgraded to buy, increases target price to 1630 rupees per share. It says Q3 performance is underscored by margin expansion, sharp decline in provision, expects stronger performance in FY27 than implied by guidance, and has increased FY26-28 EPS estimates in the range of 7 to 13%.
All right. Got that. And so there's, I think, Morgan weighing in on the steel stocks as well, right? You want to take that up?
Correct. So Morgan Stanley has come out with a note on steel. It says it remains constructive on steel spreads expansion and it has upgraded JSPL to overweight and increased target price to 1250, downgrade sale to underweight, maintains overweight on Tata Steel and maintains overweight on JSW Steel, and also says that domestic steel prices have received significant policy uplift and China anti-evolution is in the medium-term. It's a medium-term theme and global macro favors are also supportive for these companies.
All right. So thank you very much for that. Rima, you want to talk about Persistent?
Well, Persistent numbers are fine, and this is a company which has been growing very well at 3.5%. This quarter, the company's top line growth was 4.1%. Adjusted margins came in ahead of expectations at 16.7%. That was a beat. And what was interesting is the company spoke about an AI platform tool resulting in a pricing benefit which boosted margins by 150 basis points. We'll try and get more details on that. Reported numbers on the margin and profits are looking a bit amiss because of the labor code. But the problem for Persistent is the valuations because stock trades at 36-38 times forward multiple. So higher than, say, a Coforge, higher than many of the large cap IT companies, even higher than, say, an LTI Mindtree, which yesterday sold off despite good numbers, again, because of valuations being 30-32 times. Persistent is even more expensive.
Okay. All right. Just a couple of seconds to go for market open. Just counting down. And look at the Nifty in the pre-open, right? Another 90 gone, 380, almost 400 gone in the sensex as well. So 25,140 on the Nifty, 59,400 on the Nifty Bank. The sensex is at about 82,000. The small cap index is down about 1/3%, and the mid cap index will come up on your screen. It's 1/3% gone there as well. So Nifty is now flattish. We'll see if there's another wave of selling which hits, or is there any interest on the other side. But we're at 25,200, and tentatively so at this point. Nifty heat map gives you a quick sense of where we're likely to start. I mean, for what it's worth, it's just the first couple of seconds out of the gates this morning, but market breadth is deeply in the negative. But I think we should wait to before we start to focus on it. Eternal, Sun, JSW are on one end, and you got Bharti, Aisha, Shriram Finance, which are on the other end, and you got 25 up and about 22 down, and some stocks still opening up. So that's the picture at this point in time. So under 25,200 now, and a bit of selling emerging. We're down about 50 odd points. Rima.
Well, from the start of the year, the Nifty is down in excess of 3.5%, while the mid-cap index is down 4.1% in the last 4 trading sessions. This is the third consecutive day where the markets, at least to begin with, have opened in the red. On the way down, Bharti Airtel is a drag today. That's down 1%. Year-to-date, Bharti Airtel is down 6%. This is a stock which has done so well. It's up nearly 150% in the last 3 years. So profits are being now taken where you are making them. ICICI Bank is another case, an example. Stock down close to about 3/4 of a percentage point. ICICI Bank selling off. IT continues to be on the back foot. You've got red to begin trade with Infosys, HCL Tech. Both these names are down 0.5%. TCS2 lower by 1/3 of a percentage point. BEL, Shriram Finance, Apollo Hospitals, Axis Bank, Kotak Mahindra Bank are some of the other stocks where you are seeing softness. 2 stocks, Reliance Industries and HDFC Bank, once again should come up for your new screen. They've been the big laggards in the large cap space. Reliance Industries opens flat, and so does HDFC Bank. On the way up, Eternal and Dr. Reddy's. Both these 2 companies report numbers later today, and there is buying visible in them. Eternal is up 2%, and Dr. Reddy's is up nearly 1.5%. In fact, a place to hide maybe the pharmaceutical index. The Nifty Pharma Index is the only sectoral index for now, actually along with that even metals now. Nifty and Pharma is seeing buying today. The Nifty Pharma Index is up 1%, Sun Pharma, Dr. Reddy's, Cipla gaining close to about 1 to 2 odd percent. And the other pocket of strength continues to be metals, where buying is visible in JSW Steel. Hindalco should also come up for you on your screen. All in all, it's a flat start. So after 2 days of big gashes, the start has been on the quieter side and consolidating for now.
Quick couple of points, Rima. On the Nifty itself, we have gone down to closer on the 200 DMA, and normally the first time it gets visited, it gets defended. So we have bounced off that mark. A reference point today will be the 20 DMA, which is roughly around the 25,100, and today's day's low is around 25,130. So that's a crucial mark you'd want to defend. In terms of the broader markets, the breadth of the market is still weak, but it's actually it's improving a little bit. I'll tell you what, the first hour of trade could still be tricky because some of those MTF books could get squared off. Some kind of squaring off is what we'll see. That's typically what happens. And then maybe see a bit of recovery. So keep an eye out on that with regard to the broader markets. The good news today is some of these good earnings reactions, well, they are getting a positive reaction. Credit Access Grameen, Gaurav told us those numbers were good. The stock is bursting away. It's up close to around 6%. AU Small Finance Bank, that as well is doing quite well, in today's trading session. So good numbers are being rewarded, and those stocks are trading in the green. You have J&K Bank as well that's trading in the green. So pretty good going out there. The market is at least taking note of some good news. BCCL, like we saw yesterday and the previous trading session, it starts off in the green with massive volumes. Let's see whether or not it can hold in the green. A couple of stocks, though, have bounced up after seeing a big correction. MRPL, it's moving up on large volumes. That's up close to around 4.5%. So just keep an eye out on that particular name. And I think TBZ as well, that's another stock actually that came on the radar. That's up 4.5%. And the volumes are quite large on that name as well. So just keep an eye out on that. On the flip side, Jindal SAW as well as JTL, both of them did see a big surge in the last few trading sessions. They have come in for some profit taking. And it appears Shoppers Stop is getting a clobbering post its numbers. Stock down close to around 10%. Net, a decent start to trade, some consolidation, some kind of a pullback is something that the bulls would want. Not falling more is something on the wish list.
34 points, right? I mean, it sounds like it seems like such a relief, right? And so 80, 85 off the lows this morning, but it's just, initial rates coming through. Prateek Gupta is with us, CEO and co-head at Kotak Institutional Equities. Prateek, good morning. Good to have you with us here. We've played around with that liquid oxygen analogy for a while, but it seems more liquid than oxygen now, Prateek. What's happening? And it's as I was saying earlier, right? I mean, it's a confluence of things all coming together at the same time. $3 billion of FI sales, and just this is early January still. of course, that's leading to a pressure on the rupee, and that consequently, in turn, pressures the equity side. What's your sense? Are you getting a sense that this is global markets are going to crack now? Let me put it bluntly. We know what's happening here, but global markets have been very strong. 25 was a great year. Are you getting a overall sense that that is going to start to shake up a little bit?
Good morning, Prashant. I think that is actually the bigger issue globally, the overall global economic uncertainty, and more importantly, geopolitical uncertainty, given what's going on with policies around statements almost every day by the U.S. president. And I think the key marker to watch for is global bond yields. Now, yesterday we had the Japanese bond market blow up. Japanese bond yields went up to almost 2.4%, almost double from where they were last year. And that's obviously caused a little bit of a mini earthquake over there. Imagine in India, if our bond yields go from 6.7% to say 13% in a year's time, what kind of impact that would have. So far, the Japanese market is holding up, but that's one big concern. Likewise, in the US, the big fiscal deficit they're running, the current account deficit. The bond market is what you really need to watch out for. So far, even yesterday, the US bond yields were relatively well behaved. All these bond yields have been moving up, inching up, except in Japan, where they've gone up very sharply. But in most other markets, it's been somewhat stable. And also, I think the broader issue for India still remains that India is still seen as neither a high growth market in the current environment, nor are we seen as a cheap market. And we don't have any AI plays like the US or China or Korea or Taiwan. So we're sort of in nowhere land right now. And that's what's unfortunately leading to the persistent FII selling, which we've been seeing $3 billion this year, already in the first 20 days of January. And last year was $18-19 billion. And that trend, unfortunately, doesn't seem to be changing for the time being. So we are in a little bit of I would call it a cautious space right now. We're at the bottom end of the zone. But I think the globally is the bond yields is what you need to watch for. And the other thing I would also mention, by the way, is the commodity space. That's obviously also we're seeing a pretty sharp spike up in commodities, and that trend we think will continue, which is also unfortunately a little bit negative for India.
Yeah. So we ask you what's the pipeline for deals and IPOs and QIBs. Is the pipeline for FI? I mean, you'd get a sense, right? You're talking to on your desks, etc. You get a what's the interest levels one way or the other. Is there any interest from foreigners? No. I mean, it's just still sales interested in selling more. I mean, is the pipeline large, big? What's your sense?
Yeah, the pipeline is very large, obviously, even right now. A lot of issuers, whether it's the PE funds or the promoters who are looking to cash out. And there are some large deals in the pipeline. Some of them are in the public domain. For example, the NSE has talked about getting its NOC from SEBI. And there are many other such large IPOs in the pipeline. So some of these large IPOs are likely to attract a lot of foreign investor interest, obviously subject to valuation pricing at that point in time. But bulk of the IPO demand is still coming from the locals, somewhat limited interest from the foreigners. So that trend hasn't changed. But is the pipeline strong? Yes. Obviously, valuations have adjusted down compared to where we were, let's say, even back in October, November. The valuation expectations have come down, and the buyers, the local mutual funds, the local insurance funds, etc., they've become a bit more discerning, a bit more demanding on valuations, and that's obviously there's a little bit of negotiation that goes on between the buyers and sellers, but that's going on. But we've seen prices come off a little bit, and that trend I think will probably continue given this environment we're in.
But Prateek, do you see fewer deals coming to the market because valuations have corrected or readjusted? The market sentiment has been hit so hard. So the pipeline is strong, but are companies pushing back on their plans to hit the capital markets?
No, at least as of now, no, because we are still seeing companies pushing ahead. We are still seeing the filings taking place with the SEBI. So far, no. But yes, if this continues and the environment worsens further, then yes, there could be a risk. But as of now, no major pushback, no delays. Obviously, you'll have the odd one or two companies here and there which will be delaying their plans, saying they're not happy with the current valuations. But most of them are actually, as of now, proceeding with their IPO pipeline.
Hi, Prateek. Good morning. Good to see you. And Prateek, the next big event is going to be Budget 2026. Any hopes out there? Because otherwise, you don't know what Trump's going to do next. TACO is not existing for the last few months. Otherwise, at least he was backing out after announcing something. Some hopes in Budget 2026. Your expectations?
So I'd say, Nigel, the good news is expectations going into this budget are relatively low. There is not that much room for fiscal stimulus. Maybe, if anything, the government needs to reduce its central fiscal deficit a little bit by maybe another 5-10 basis points in FY27. We've already run out of monetary stimulus. At best, you might get another 25 bips of a repo rate cut. So expectations going to this budget are low, but we think actually there is still a lot that could be done in terms of what I call a governance stimulus. What that means is things like deregulation, simplification, fixing things like in the inverted duty structure and so on. The one theme I would highlight, and this goes back to Prashant's point earlier about the rupee, I think the rupee has come under pressure. Our forex reserves have been coming off, and frankly, these are not our own reserves. India doesn't have a current account surplus. These are, frankly, someone else's money. We are holding all the FIs and FDIs and so on. So I think watch out for steps which will be supportive of things like exports, import substitution, getting more FPI flows into the country, getting more FDI into the country. This could be whether it's tinkering around with foreign limits, or maybe they do something for capital gains tax for foreigners, something, whatever. But basically, watch out for steps which would be rupee supportive and positive for capital flows into the country.
Prateek, if this Trump policy uncertainty persists, we still don't hear back from a Supreme Court from the Supreme Court about whether Trump's tariffs are valid or not under IPA. And this unpredictability flip-flop continues. If that is the base case for the next 3 to 6 months, how do you think global markets, US markets, emerging markets, and Indian markets in this context will perform or behave?
So firstly, at least based on our conversations with various global experts, they believe that the US Supreme Court, even if it reverses the Trump tariffs, they'll figure out some other way to continue with the tariff regime. So that should be maybe just a temporary relief. They can always come out with some other law in the constitution and pull that out to impose tariffs on various countries. So, or they can pass a new law. So that may be just a temporary relief. So the base case, it probably is going to be that you will see higher volatility across the globe. And that also, therefore, I would argue that India in that context is relatively, I would say, given that we have already corrected a bit and maybe a little bit more, but our macro outlook is still somewhat stable. Whether it's the inflation is under control, growth is not great, but it's okay. It's 6.5-7% expectations going into the new financial year. Inflation is okay, like I said. Currency, hopefully the worst is over, and if the government can come up with things to attract more FDI and FPI, that may stabilize the rupee. And if we get these FTAs signed with the UK, EU, etc., that may help kickstart the export engine to some extent. So it's not going to be an easy environment for India. It is going to be a very choppy environment, which is why this year, I think from a portfolio strategy, we're recommending a somewhat of a defensive stance, be cautious, protect your capital first. Don't expect very strong returns in this calendar year, at least not until things, we get some more clarity on what's going on with the US.
Prateek, but overnight we had the EU chief talking about the deal with India will be the mother of all deals, with regard to India and Europe. How good will this be? Suppose we get that mother of all deals, but the father of tariffs is saying that the deal with India is not really happening. In this sort of a scenario, how do you see things playing out? I mean, So we have to thank God for small mercy. So at least we're getting a deal done with Europe. Your comment on that?
Yeah, as you said, I think the mother of all deals may be good, but may not be good enough until the father of the tariffs figures out, turns a bit more positive on India. That's clearly impacting both local and foreign sentiment. So you need the father of all tariffs to turn more favorable on India. Until then, I think the EU deal and the UK deal, there'll be nice lollipops, or not lollipops, I would call them nice, very good steps in the long term, but they'll take time for India to ramp up, our exporters to ramp up their exports to EU and UK. US is still the biggest market in the world, and if you're not sort of favorably well positioned over there, I think it's a problem. But I think, having said that, the EU and UK FTAs, all the other FTAs which the government is doing, the UAE, the Australia, and so on, those are very, very good steps. They will take time, but those are what the government those steps are very important for boosting our overall export engine and diversify away from the US, which, as you said, until the father of all tariffs turns more favorable to us, we have to keep working on the other countries.
Just a quick one to this, Prateek. If you did a straw poll at Kotak, is the market price correction wise done? 5%, 10% more? Where would the majority land?
So as far as the large caps are concerned, I think we are almost there.
Okay, almost done. Broader markets? Yeah. Sorry, rushing you because we are rating.
No, I think mid caps and small caps, we think there's more downside. These stocks are still trading at a 30-40% premium to the large cap index. Valuation, the prices have corrected, but earnings have also corrected. We've seen earnings downgrades, and therefore small mid caps would still be a bit cautious.
Got it. Thanks very much, Prateek. Speak again soon. Thank you very much for joining us here on CNBC-TV18. Well, let's quickly get you the highlights, more highlights from the World Economic Forum's annual summit underway in Davos. My colleague Shreen Ban caught up with the IT Minister, Ashwini Vaishnav. It was a power-packed town hall with global Indian IT services powerhouse, TCS, Infosys, Wipro, and the top bosses at each of these companies. Listen in.
The India AI mission has an allocation of a little over 10,000 crore rupees. Separately, you, of course, have the semiconductor mission, both of them running in parallel. As you look at the AI tier cake today, where do you believe India is best poised, best positioned, and what will be the next steps in this journey?
The AI stack basically has 5 layers. The application layer, which is where the AI would be used. Second is the models layer. Third is the semiconductor, the chip layer. Fourth is the infra, data centers, and fifth is the energy layer. We have to play in all the 5 layers, given the size of our economy, given the way our country and our people are so tech savvy, the way our people have adopted technology in the past, the way our IT services and all the 3 big leaders, top leaders from the IT services are present here. They have been providing services, IT services to the world. So I think, and we are at this point of time, working on all the 5 layers. Of course, our very big focus will be on making sure that our IT services companies, they keep that momentum and they provide the AI-enabled services to the world.
Kriti, let me start by addressing the issue with you from the lens of what TCS is doing. You aspire to be the world's largest AI services tech company, but from your own lens, as well as the imperatives for India, what should the next chapter in our AI journey as a country look like?
See, if you look at from what the traditional lens, most of the Indian companies are good at, the traditional services companies. I agree with what the minister said. He talked about the 5-layer approach, and what in TCS we call it the infrastructure to intelligence. There are multiple layers from infrastructure. There is a model layer, there is application or the agent building layer, and the experience layer on top. And while many of the IT companies in India have not built their own models, but we should not lose fact that the value actually comes in understanding the business context of our customers, ensuring the data for our customer data works for them. And I think that's our core capability. And most of us are focused on that, and you'd see us delivering value from that.
So there's going to be no change. You're not going to go the LLM way.
I'm not saying there won't be change, but don't underestimate what we are doing. We somehow seem to underestimate or brush aside saying, you guys are not doing models, so your legacy. No. What we actually do is making a real for our customers. Model is one component, but making the models work and work for the customers is the most important. That's where the value is.
Well, speaking of value, and to Kriti's point, there was a lot of gloom and doom around the fate of the Indian IT services sector and what AI could potentially do. But each one of you in your conversations with me have said you see this as a tailwind, but you also see this as a reset. Salil, talk me through what this reset is likely to mean for companies like yours, but more importantly, for the sector and for India at large.
So I think AI is genuinely something that is changing both our company, but the industry and India. What we see are huge, large value creating pools of opportunity. There are 6 of them that we've identified. For example, there's a whole set of work on AI engineering. There's a whole set of work on software development and modernization. And those combined have a large value that all of us, all the industry, for the benefit of India will enjoy. And those are growth vectors that we see coming in the coming years. Yes, there are other places where we see some shrinkage, but this growth we see over the next several years compensating for it. So there are practical examples, as Kriti was saying, as the minister was describing, in terms of where we can help global companies. For example, if you're doing something on modernizing the infrastructure, those things were not affordable for companies in the past. Today, with agents, they will take less time, less money, and those become much more affordable, and we are starting to work on those areas now.
Rishad, just to take that forward, because I think the question that's being asked today is what is it going to do, not just for global growth, but what is it going to do for growth in India? What kind of tailwinds does this provide? And more importantly, the ROI question as well, because, significant investments are being made. What is the realistic return on investment period that we're talking about?
So first of all, Shreen, I think the way you should think about the services industry is any technological change, I believe is good for the industry, because to make that technology relevant inside of large organizations that are complex and messy, that have legacy, that have data that doesn't speak to each other, that's not organized, that are buying companies, that are spread across the world, you need partners to make that happen, right? So the opportunity for both India as well as for companies in India is to really take this and make large organizations adopt it, right? To Kirti's point, to make it be adoptable, you have to move from these general purpose, highly plateauing LLMs to be highly contextual, to understand the context, to understand the domain, to understand the workflow, to understand the data, to bring it to life on scale. And I think that's a huge journey and an opportunity for companies like us, all the way from thinking about the AI advisory story to all the way to making it real, right? With a very strong DNA of having safety and trust and strong governance, fairness, lack of bias, etc., and change management, very implicitly a part of the DNA of the process as opposed to an after-the-fact element. I think India separately also has a huge opportunity as a country to demonstrate scaled adoption with speed, showing it in many, many specific areas, right? Areas of education, healthcare, governance. So there's a huge opportunity both to take the story, to take all the infrastructure investments that have happened and to make it be consumed both with India as a story, as a market, but also us taking it to our global customers. And so I'm quite excited as to how this journey unfolds over the next 3 to 5 years. It's also a question of how bumpy it can be. And maybe it can be a little bit bumpy, but there's a huge opportunity. The last thing I will mention is just the element of talent, right? We've been a talent destination to the world for the longest time. And I think there's a huge opportunity for us to continue being that talent destination with AI. And our investments, both as companies, but as a country, will be incredibly important to keep that differentiation, because there is no progress on AI without the right relevant scaled skills around AI.
Very interesting conversation there. But for now, it's time for a break. On the other side, we'll be joined by the management of EIL to discuss their business outlook as well as the big order win that the company won in Nigeria.
Welcome back. Let's turn to the corporate part of the show then. We have Engineers India. That's the next management on the show. The company recently bagged an order from Nigeria's Dancourt Group for refinery expansion. The contract is valued at around 3,200 crore rupees. To discuss this and more, we have with us Ms. Vartika Shukla, the CMD at Engineers India. Well, ma'am, thanks a lot for joining in. Just highlighting to our viewers first what we're going to be focusing on, the order book breakup, domestic versus exports, the 20% growth guidance. Is it intact for the coming fiscal? And diversification beyond the oil and gas space. Well, appreciate you joining in, ma'am, and congratulations on this big order. Give us a few details, though. What kind of margins will you enjoy on this order? What is the timelines as well? And revenue recognition with regard to this order. Please go ahead.
Thank you. It's a pleasure for me to be on the show and share one of the most significant milestones that our company has achieved on a global platform. We have actually built the first train of the Dangote refinery in Nigeria, which is about 650,000 barrels per day. And based on the services we rendered, we have got the highest order in our history ever for close to about $360 million, which will entail the engineering, procurement, construction supervision, and complete project management for doubling this capacity from 650,000 barrels per day to 1.2 million barrels per day at that location. Additionally, we are also implementing at the same location for an order value of about $70 million, 4 trains of one of the highest capacities of urea, which is 4620 TPD per train. 4250 TPD per train. What it brings to India and to EIL is that we are able to export our services as a repeat client who values the technical excellence and the integral offering that the company has from concept to commissioning. It also has a time frame of about 3 years. So we see the revenue growth coming from this project execution for a period of 3 years or so. If you've seen our half-yearly results, we are already up in terms of our revenue recognition based on the previous orders that we have received in the last couple of years. And this large volume international order which we have puts us in the order inflow this year is something like 65% from international territories and about 35% from domestic sector. So we will be in times to come have a significant volume of international revenue in both the top line as well as the profits in the bottom line.
Okay, so 65-35 is the mix of the order inflows in FY26. Ma'am, what's the order book now? It was at 13,100 crore as of Q2, and the total order inflows that we've seen so far in FY26. And what could that number rise to as we close out this year?
Sure. So we did a record order inflow last year of about 8,214 crores. This year, as we are still having about 2.5 months to go, we are already touching 7,600 crores of order inflow. Please also remember that these orders, international orders, are in dollar terms, and they would commensurate, they will convert to rupee terms with the fluctuation of the currency. But today our order book is an all-time high. We've broken all records. It is close to about 15,800 crores as a total, with about 40% of our order book as of now from international territory.
Okay. You said this order, this large $360 million order from Nigeria will be executed over the next 3 years?
Correct.
Right.
Correct.
So for FY26, you still have about 2 months to go. What will be the contribution? And is there a case that you will beat your own guidance of 25% on the top line that you had shared?
So these projects are long gestation in the terms of execution. It's typically 36 months to 40 months is what we would see as we go forward. And it follows a kind of an S curve in its execution. wherein it is in the initial stages when the engineering work happens, we don't have much of ordering and capex commitment happening in the first 6 to 8 months. So we see for the next financial year it converting substantially to the turnover. In this financial year, it will be a modest impact in the turnover, and the guidance we have given on a 25% uprise in the turnover in comparison to the last financial year is maybe marginally up, but not significantly.
And since incrementally you are getting more international orders, what does this mean to your overall margins? Because last time you gave us a split between turnkey and consulting. But now as the mix shifts towards more exports, international orders, what could the consolidated margins look like?
When we work in the two segments that we do, largely the oil and gas complex mega projects, and also some of the other, chemical fertilizer projects, and the other segment which we do in urban solutions, infrastructure, etc. The margins depends on the complexity of the, projects. So we have already seen an upward swing in our margins in the half-yearly results that we had, shown last year. Last year, in fact, September 25. In the quarter, we had a margin of 11% in comparison to June of 7%. And on an overall basis, on the half year, we were up by 1% on the operating profits and margins. So we do see a very strong projection of a similar kind of margin in the overall, both the consultancy and in the LSTK, we are obviously more competitive and our margins are slightly lower. But consultancy segments, we've shown margins of about 25 to 28% very consistently over the last quarters. And this overseas segment, again, is a high value and high complexity project, which will definitely bring in a lot of skills which are valued much more than, the conventional LSTK or the some of the urban solutions that we offer. So we do see robust margins going forward, even though our international segment will be significantly higher than last financial year.
Thank you, ma'am, for joining in. That's Zabar coming in on EIL. Moving on now to our special segment, Quarter Se Quarter Tak. Let's get you up to speed with what to watch from the big pharma earnings, and it begins with Dr. Reddy's later today. Ekta?
Thanks for that. Well, pharma companies are expected to deliver steady revenue growth in Q3 aided by domestic formulations. EBITDA may remain muted due to the competition that we would see in the US. The US generics market has largely remained stable with the flu season providing support. High base for Revlimid generic, which is the cancer drug, is likely to weigh. The street is expecting a decline in sales for the likes of Dr. Reddy's and Cipla this quarter. Lupin is likely to possibly outperform on the back of traction in key products, while Sun Pharma's specialty portfolio is expected to drive US growth. Domestically, sales growth of around 8 to 9% is expected, though margins may be pressured due to the labor code implementation. Ajanta Pharma Eris is expected to lead with double-digit growth, while the likes of Glenmark, Alchem are estimated to post mid to high single-digit growth. In the CDMO space, watch for global innovators spend picking up. Divi's and Loris are expected to deliver around 15% growth, but do watch out for the margins for Piramal Pharma, which are expected to improve sequentially. Now, the key focus areas this quarter would include the obesity drug opportunities, US pricing pressure, onshoring of manufacturing in the US, the Biosecure Act, and progress on key launches. Let's leave you with a valuation table in terms of where things stand with regards to a lot of the pharmaceutical companies, with the likes of Sun Pharma, Dr. Reddy's, Cipla, a lot of them trading very close to where they were around 6 months to a year ago.
Thank you very much for that. Kunal Dhamesha, Pharma and Healthcare Research Analyst at Macquarie Capital, now joins in. Kunal, just beginning with Dr. Reddy's, because that's the first one off the block. As Ekta was saying, that US sales will be impacted because of the Revlimid base. That's known. How much of that will be offset? I mean, and is that already in the price?
I would say, it's definitely going to be lower sales in US on a sequential basis. Though I still believe that there'll be some tail end revenue coming from generic Revlimid in this quarter. and it will completely become immaterial in the quarter 4 of FY26. But there'll be some contribution. Now, it's very difficult to kind of pinpoint what that contribution is. But we are building some contribution, and that is going to still support the quarter 3 earnings. Over and above that, what we see for Dr. Reddy's is the other businesses, like domestic business remains strong, double-digit growth that we are expecting in quarter 3. Similarly, the other emerging markets like Russia and other emerging markets, there we are seeing a lot of currency-related tailwind. So on a year-on-year basis, let's say average ruble INR rate has depreciated by around 34-35%. So such a strong currency tailwind is also going to support the performance in this quarter, primarily due to the translation gain.
All right. Hi, Kunal. Good to see you. And just going to get back to this quarterly's expectations. But I want to ask you about Sun Pharma. These various reports are indicating that they are looking at a big bite in the United States, a possible $9 to $10 billion acquisition. What is your reading? For the time being, it's still in a bit of a flux. But if it does happen, then what's your take?
I think we'll need to look at what valuation it does happen and what strategic and financial rationale that company is looking out of this potential purchase. So it's difficult to comment anything at this point in time, but certainly going to be a big transaction if it goes through. But we'll look for more details.
Done at these sort of valuations, though, $10 billion, would it be, they're looking at too big an acquisition, or do you think we'll have to further see details and then only take a call?
I would look at more details and then take a call.
In all the pharmacy, back to Dr. Reddy's, I was just seeing the valuation plate that Ekta put up. It's the cheapest of the lot. FY27 PE is about 20.5 times, lower than Sun Pharma, 28 times. Cipla is closer to 24, Biocon 37, Lupin is close to 24. So in the pecking order, there you have that plate. Valuation-wise, which one do you think is most attractive or risk-reward is favorable?
I would say valuation-wise, a lot would depend on the post-Revlimid earnings on FY27 and how the GLP-1 opportunity plays out, especially for players like Dr. Reddy's, where I believe that Street is kind of slightly more optimistic on what they can do on the generic semaglutide, especially in Canada. But we have seen some bit of disappointment on that front. With Canadian Health Canada issuing the notice of deficiency, and then their expectation of getting the approval to be the first player in the market could be questionable now. But we'll keep on monitoring this trend. But I believe at least for Dr. Reddy's, probably generic semaglutide is where consensus expectations can moderate for FY27, and hence what valuation we see around 20.5 times could actually be higher with the lower earnings. So between the pack, I would prefer Lupin, which is where there is no generic Revlimid related cliff, and they have strong contribution coming from generic tolvaptan, which continues with a limited competition at this point in time. But it is a well-known fact, no one is kind of extrapolating that tolvaptan into FY27. So to that extent, FY27 earnings are de-risked, and even in the domestic business where they are one of the top player in anti-diabetic, I think they could be a key beneficiary of the GLP-1 genericization in India.
Interesting. Lupin, right? So I understand, Kunal, then out of in your coverage universe, Lupin ranks the highest as a conviction idea?
Yes.
Right. Do you have coverage on the entire CDMO space? I mean, companies there?
Yes, I do cover.
And again, I mean, that was seen to be as this secular theme. Is that road still clear? Again, which is the best one to play there?
Sure. So I would say after the Biosecure Act became law in the December, the biotechnology companies of concern is linked to the 1260H list, which gets published by the US Department of Defense every year. Typically, for the last 4 years, it has been published in the first 2 weeks of the January. We have not yet seen the updated list for 2026. But I think all eyes are on that list. And if the key Chinese CDMO companies are included, like WuXi AppTec, WuXi Bio, etc., gets included in those lists, then I think the road becomes much more clearer for Indian CDMO companies for the next 3 to 5 years, because they can see that incremental contracts, especially on the manufacturing side, which could increase the sector growth rate itself from low teens to high teens level, in my view.
Yeah, no, absolutely. And you have coverage in hospitals as well, right?
Yes.
Kunal? Again,
Yes.
best bet there?
So I have a cautious view on the hospital sector because the entire sector is entering into a strong capacity expansion cycle. So 8 large listed hospital currently has 40,000 bed capacity, and their next 3 to 5 year guidance is to add 20,000 bed. So they are versus that, in the last 7 years, these same 8 companies have only added 4,000 beds. So you see there is a 5 times capacity expansion coming in the next 5 years versus the last 7 years. Which eventually will get absorbed over the next decade. But I think initially it will cause some bit of drag on profitability, which is not well factored into consensus estimate at this point in time. And valuations for my coverage companies like Apollo and Max still remains well above their historical average plus 1 SD. And hence I remain on sideline for both these stocks.
Okay, all right. Kunal, appreciate you joining in. Looking forward to chat up with you as the pharma earnings do come in. Well, by the way, guys, just looking at the broader markets, a few stocks have seen a good recovery. Walchand Nagar, the stock was in the red. That's popped up in trade. So good recovery is what we're seeing on that name. Credit Access Grameen, that's the earnings reaction of the morning. Locked up close to around 10% as we speak. So fantastic move is what we're seeing out there. Supreme Petro as well. That's another stock. I think it was down 7-8%. That one as well has popped up. So there are a few winners. The screen is still looking very jittery. But from the low, some of these stocks have recovered on decent volumes as well.
No, absolutely. And some of them are up on your screen. You mentioned Credit Access, and I think there's more. Maybe I can...
There's an upgrade on Credit Access. CLSA has upgraded the stock to a buy with a target price of 1450. HSBC has also upgraded Credit Access, where the target price has increased to 1630. So numbers are good, and then there are these upgrades.
It had actually rallied all the way to about 1500 late 2025, and then it had a very sharp fall back to 1200. But from the depths of, all the doubts around where this MFI cycle is going to, and the depths on this stock was around 750, 800 rupees. I mean, it is still doing very well, relatively speaking. So it's been kind of the winner, the highest quality name in the MFI space. Sudarshan is here with his, take on markets, which have had a weak start to 2026. I mean, 25 was bad, and 26 not exactly a good one either so far. So take it away.
So, well, if you had thought that after muted 2025, we would have a better start to 2026, well, that's not the case. It's the weakest start for Indian equities we have seen since 2016. Well, that's in the last 10 years. And it's a third straight year that we are seeing a negative return for Indian equities. And it's been just 13 trading sessions, and Nifty is down more than 3.5%. And this loss has led to BSE-listed companies erasing market cap of more than rupees 20 lakh crore. Now take a look at the move of some of the major indices. Nifty is down more than 3.5%. Same for sensex. Nifty Bank has relatively outperformed its flat for the month so far. Major pain has been seen in the broader markets. Nifty mid-cap index is down 4%. Small cap index is down almost 6%. Which are the top Nifty losers? Well, 33 of 50 Nifty stocks have so far this month have given negative returns. And of those, 4 stocks are down in the range of 10 to 9%, and 19 stocks are down in the range of 4 to 9%. And top Nifty losers, ITC down 19%, Reliance down 11%, Trend down 10%, Jio Finance 10%, Wipro 9%. And if you take a look at the data of last 1 year, Indian market has been the biggest underperformer. In the dollar terms, it has given positive returns of just 4%. And if you compare Indian market with global markets, S&P is up 12%, DAX is up 32%, CAC is up 17%, Nikkei 33%, and same for Hang Seng. So we'll have to see how the next few days pan out, and it all depends on what kind of commentary we get from one man, and that's one and only Donald J. Trump.
So thank you very much. We could have ended that last plate with a picture. So 6:30 p.m. right is today, when he'll be making his speech in Davos at the World Economic Forum. Remember last year, I think there was a speech from President Trump, but it was, of course, made from the U.S. This time it is very much him leading the largest ever contingent to the US, to the World Economic Forum. So that is that. KPI green at the bottom of the screen, some numbers coming through as well. Siddharth Rai is with us with some technical trading ideas. Siddharth, good morning. Good to have you here. I mean, just the setup and what would you want to do?
Hi, Prashant. Good morning, and thank you for having me on the show, first of all. See, Prashant, if we talk about Nifty, there are two ways to look at the index right now. First, on a positional basis, Prashant, the structure in the index has been completely distorted over the last couple of sessions. And now I think that the room has opened for a move towards 24,800 and 24,600. So it won't be a good idea to be going contrarian and to be buying at these levels, even though the market seems to be oversold. But having said that, Prashant, in the very short term, because we saw an extensive sell-off in the yesterday's session, there can be a small short covering towards 25,300, 25,350. But that will only be an opportunity to take fresh short positions on the index, because as long as we are below 25,400, 25,450 in Nifty, the structure is very weak. And as I said, the room is open for a move for this fall to extend towards 24,800 and then 24,600.
Okay, all right. Not sounding very optimistic. If there's a bounce, maybe in fact it's a shorting opportunity, going by what Sid is saying. Sid, but individual stocks, they'll call for attention, right? Give us those ideas.
Yes, sure. Hi, Nigel. See, two stocks, and I think it's a good time to be having a balanced approach in markets. So one stock we have to buy, and the other one we have to short. The first stock which we have to buy is Tata Consumers. See, over the last 3-4 sessions, the stock has consistently tried to give us a breakout, but because of the overall sentiments of the market, it goes up and comes down towards the ending of the market. But I do think that eventually we'll see this stock moving to above the 1200 mark, and then a fresh momentum will begin. So Tata Consumers can be bought right now. The spot is around 1185-ish. We can buy it here. The stop loss will be at 1165, and our targets being above 1200. Just like I said, the first target 1220, the second target 1245. The second stock is L&T Finance, and this one we have to short because the structure looks very weak. There was a very important support in this stock around the 287, 288 mark. For the last 1 week, it was able to maintain the support, but today with a very, very sharp fall, this support has been broken, and I think this fall will be extending from here. So L&T Finance, we can go short on this one. The January futures are trading around 283 right now. We'll go short, and the stop loss will be at 295. And our targets being the first target 260, 260, and the second target 255.
Got it. Okay, all right, Sid. Thanks a lot for that. By the way, just keep an eye out on the bottom of your screen. We had a new listing, Amagi Media, listed, I think, at a 10% discount, but quickly that got bought into. Keep in mind, this is a issue that got oversubscribed by around 25 to around 30 times, on the whole. So a bit of a recovery is what we are seeing from the lows. And I think KPI Green, as Prashant mentioned, numbers look pretty impressive out there. Promoter entity as well has taken warrants, I think, at around 470 rupees or thereabouts, 1 crore warrants, just reading their last release. So that one as well has perked up. Numbers on a year-on-year basis look good. And the promoter issuing warrants as well had given some confidence earlier. Time is to slip into a short break, though. On the other side, we'll be joined by Sunil Singhania, founder, Abacus Asset Manager, to help us out with what's the perspective from the markets from here on.
Okay, welcome back. Markets, of course, trying to find some direction. It's been painful and a tough start to 2026. Well, we have someone who's seen markets across cycles. Sunil Singhania is founder at Abacus Asset Managers. Sunil, good morning. Great to have you with us here. Thanks very much for joining us. And of course, Sunil is someone who's also now launched a mutual fund. He's got a flexi cap running. He's got a liquid fund running. And of course, I mean, the IPO happened. The NFO raised about 2,500 crores on the flexi cap side earlier, towards the end of last year. Sunil, so, I mean, the question top of mind for many out there is simply this. Is this are we close to a bottom? Or, and you know, one can live with the ambiguous answer on that, but people are more worried about the second option, which is this the start of something bigger on the downside? How do you respond to that, and how would you answer that?
Good morning, Prashant, and very surely I think 26 has started off with a lot of news flow, a lot of concerns, and obviously on the face of it, things seem to be obviously very challenging and very stressful. But having said that, I think the lot of parameters are starting to show signs of I would say scare at the peak. The number of new lows which we hit yesterday was almost 750, 800. It's a good indication. I think 52-week lows after a not so great year, particularly for broader markets, point that a lot of investors are giving up and just throwing up stocks. On the other hand, on the global side, yes, I think this Trump mania has been reaching peak. But now I would say the good thing is that almost all countries have started resisting it. So, US is 25% of the world's economy, and maybe in the next 10, 15 years, that 25% will fall to 17, 18%. So I think now 75% of the world economy is almost in sync that, it is going too far. And I would say that that itself is again going to lead to a lot of other permutations being made. We heard the EU chief talk about the mother of all FTAs being signed with India. I think we have a budget coming in. The macro parameters are pretty steady and healthy. Balance sheets of corporates are pretty steady and healthy. Obviously, the external environment is such that growth is right now on the corporate profit front stuck at 9-10%. But looking at the scare and looking at the kind of views and news flow coming in, I would stick my neck out and say that, it's time now to start investing. In fact, last 1 week, we have been quite aggressive in investing.
Sunil, many have sort of shifted their portfolios on the institutional side to large cap heavy. I mean, some have openly said, well, it's time to kind of sort of hide, and if you can find high dividend paying stocks, you get paid to wait in that sense. Is that something you're doing as well, or I mean, just large caps versus mid caps, small caps? When you say that it's time to start to nibble and get in, where exactly?
So, Prashant, I repeat again and again, it's not about large cap, mid cap, or small cap. It is about stocks where there is visible profit growth and valuations are not out of whack. In fact, some of the biggest losers have been some very large companies. And, I think the last 10, 15 days also, we have seen so many index stocks fall by more than 10%. So it's not that it is only the mid and small cap. Yes, on the small cap side in particular, stocks had moved up significantly in terms of their multiples. And earnings have not kept pace with the expectations. So, selectively you see stocks having fallen more. But I would continue to say that, focus on companies where you have a little bit more visibility in terms of earnings and where you're not, paying like an abnormally high multiple to buy into it. There were a lot of momentum stocks, and, momentum is very pleasing if you're on the right side and equally painful if you're on the wrong side. In fact, there are so many stocks which people would have jumped to buy at these prices even 3-6 months back. But it always happens, a falling knife no one wants to catch. And I would say that even on the mid and small cap side, we are at least being a little bit more proactive and trying to see where we can get value in this, really fearful times.
Sunil, how would you characterize yesterday's price action, what we saw? There was panic selling. We almost thought there's capitulation taking place in the way the mid and small cap collapsed in the last 1 hour. Are people throwing in the towel? What have you heard based on what's the price action over the last couple of days?
So it always happens, I think investors wait, and then there are time comes when they really get fearful. And I think the call that time is that, Chomil kind of a scenario, sell what you can sell, at least create some cash. That always happens. I think it's a reverse in the bull market where you have 750, 800 stocks touch new highs and everyone wants to buy. I think we are on the reverse right now. We have so many stocks at 52-week lows and everyone wants to sell. So I think it's a phenomena. There is also a margin funding trades which get unwound, particularly in the first 2-3 hours, you have a lot of those kind of trades which are forceful selling, which you might see even today. I don't know, but it always happens. So it's a way of life as far as the markets is concerned. We have seen this kind of scenario earlier also. This time it is the entire world which is facing this mania, not on the equity side, but at least on the news flow front. Hopefully, I think sanity will prevail, and that might be the trigger which the market is looking at.
All right, Sunil, good to see you in and good to hear your comments as well. Give some comfort to investors as well. The problem is the recency bias, right? What we saw a couple of years ago when the SMEs did very, very well, there was a rush out there. Now, in the recent past, gold and bullion has done well. And there is a bit of a rush out there. So if you're speaking to, say, an investor who's allocating fresh money today, and is looking at the bullion market and then looking at the equity market as well, what would you tell them? What would the advice be as of now? And also, since you're deploying money, could you give us the top 2 themes for 2026?
So one is, if someone asks me about gold and silver, I am very honest in saying that I did not predict the rise, the meteoric rise. So I'm not the person to go to predict what we should do right now. But again, as you rightly said, Nigel, there's a recency bias. And what has happened in the last 1, 2, 3 months, we continue to believe is going to happen going forward also. I think we have seen a crazy kind of move here. As long as there is scare and panic in the world, I think these are, safe haven kind of an asset. But from these levels, I would say the probability of going up and going down are maybe even. But I would be honest, I have not been an expert in predicting their rise up, so I don't think I'm capable to predict what is going to happen in the future. As far as our preferred picks is concerned, I think they remain the same. We continue to be pretty optimistic on financials. I think this is one sector where earnings have been pretty good, asset qualities are good, and visibility is also pretty good, not only in fund-based but also in non-fund-based financials. We continue to like pharma. It's not done anything. In fact, it's been at the receiving end last few weeks. But I think, again, it's a sector where both domestic pharma as well as global pharma, the growth on the revenue front looks pretty good. Yes, there have been some concerns over likely tariffs even on the pharma side, which is suppressed price, but we would be quite optimistic there. And metals, I think the trade has worked well for us, but we don't go beyond 8-9% allocation to that segment because it's deep cyclical. But that trade has worked well for us, and it's to some extent insulated us from the pain we have seen in some of the other sectors.
Sunil, I know it's unknowable, but 10 days out, we have the union budget. And lots of, because there is so much pain all around, the median stock in the NSE 500 is down 25% from its 52-week high, even as the Nifty is down only 5%, right? Lots of chatter, talk amongst market participants. I'm sure you would have noticed on what, if some relief can be provided on taxation front with regards to equities, etc. But government revenues are also under pressure. That is also a fact. So how would you think about this, the budget, and should we expect any help at all? What's your sense?
So again, Prashant, I think this is the first time I'm seeing that no one is talking about budget, even though it's only 10 days away. And I think that is great because the expectations, frankly, are not there at all. And it's a good thing because, budget, frankly, from a tax change perspective has become less and less relevant with this GST Council and all. Now, on the income tax front, capital gains front, there have been some tweaking, and obviously the market did not like it when it was done. I don't know whether there is any thought there or not, but I would say that if the budget continues with its last 3-4 years approach on a more planned expenditure, while maintaining fiscal prudence. I think that is what the market would be looking at. But the best thing is that because the expectations are hardly there, at least the possibility of disappointment is very, very low.
Well, I think. Well, that's well put, Sunil. Possibility of disappointment is low, prices are down, sentiment is down and out. So we'll see what happens, but keep expectations low and you perhaps may just get surprised on the positive side. Thank you very much, Sunil, for joining us here and talking to us. As I said, it's been a tough start to 26, but as Sunil said, and this is the time to look for opportunities, of course, very selectively, and this is not large caps or mid and small caps. Look for earnings growth certainty and, of course, some valuation comfort as well. Thank you very much once again, Sunil. We'll take a break. We're back on the other side. Our special segment is The Economy. Lata in conversation with the former PAR Secretary and the CERC Chairman. We also have Nikhil Negania joining us on this discussion next. Discoms as a whole have turned profitable for the first time, I think. So that's the focus, the key point. Lata, up next.